All right. Thank you everyone for attending this month's market update webinar for May 2023. We'll hop right into it. Start with some disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer, solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Of course, investments involve risk and unless otherwise stated are not guaranteed. And please be sure to first consult with a qualified financial advisor before implementing any strategy or commentary within the presentation. And of course, past performance is not indicative of future results. You can see our website for additional disclosures. And throughout the webinar, please use the button at the bottom, the Q&A button, to submit any questions you have. I would be happy to address them at the end. I see a few new faces, so I'll start with the bio. My name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. You can learn more about me on my LinkedIn page. And Silverstone Financial is a fee-only fiduciary registered investment advisor. We provide wealth management and financial planning services. You can learn more about us on our website, silverstone.financial. So let's hop right into some notable events. It wasn't as crazy as last month with the Silicon Valley debacle, but we still had quite a large, big splashy headline, which I'm sure you guys at least heard about, which was the First Republic Bank failure. This is now the second largest bank failure ever in US history, right after the Washington Mutual collapse in 2008. What basically happened was there was a whole lot of withdrawals from First Republic amid the fears of all the other regional banks. And First Republic was a rather large bank. They catered to mostly ultra high net worth clientele. Another one of those niche types of clientele, like Silicon Valley Bank, had a whole lot of venture capital firms and companies and such that were their clientele. Here is another quite niche clientele that was rather affluent, and because of the smaller clientele, they were a little more susceptible to a bank run and to having difficulty fulfilling their obligations as people withdrew their money. So what it came down to was there were two main firms bidding to purchase First Republic Bank. It was slightly easier to get this bank purchased than some of the other collapses earlier this year, simply because this was seen as quite a good bank, or at least a bank that had solid profitability, solid client base. Most banks want to work with the ultra high net worth clientele. You can have higher margins and such with them. So it came down to PNC and JP Morgan. Ultimately, JP Morgan was the company that purchased First Republic Bank, and as of this week, all First Republic Bank locations are now JP Morgan locations. And I believe that Jamie Dimon, the CEO of JP Morgan, said that they're scrapping the name, so we won't be seeing First Republic Bank locations anymore. And that's just how it is, I guess. You see I listed the three largest bank failures, with Washington Mutual in 2008 being at 300 billion, near 400 billion inflation adjusted, and the First Republic Bank and Silicon Valley Bank down in the 200 billion. Still massive failures, which will not help the banking system or the economy in general. But thankfully, this one was handled very quickly and was handled through a purchase rather than a bailout through different kinds of protections of the FDIC, their insurance space and such. So it's better, in my opinion at least, that JP Morgan purchased them, but it's not a sustainable solution if there are future bank failures, which hopefully there won't be, but it is possible. Another notable event that is happening currently is the debt ceiling and potential US default in 6 weeks. It's definitely getting plenty of headlines and is quite political. Lots of different pointing of fingers across the aisle and such. Ultimately, I think they're going to do what they always do and go right to the end of the line and then finally come to a solution, and we won't default. But it is technically a risk, and it's important to know that if the US defaults on its debt, basically most of the world's financial systems will crash in some significant way. But again, this has happened many times in the past where there's a lot of threats of default and not raising the debt ceiling, and they always do come through because none of the political figures would be reelectable if they cause the entire world's financial system to crash. So I don't expect anything bad to happen. Another interesting thing that we saw this past week and so was the Hollywood Writers Guild strike. Not totally sure if it gets the level of financial news that is broadly important enough to bring up on this webinar, but it was intriguing to see. It happened last time in 2008, and there were causes for a lot of different shows, like late night shows and movies and television shows. They all came grinding to a halt simply because of the Writers Guild strike. And we're probably going to see that continue into this year, which is unfortunate because everyone likes good programming. So hopefully they'll come to a solution soon. So those were the three of the big headlines that you saw. Today was the Federal Reserve FOMC meeting, and they had Federal Reserve. They raised the Federal Reserve rate. And so we'll talk about that more on the next screen. But before we do, I wanted to quickly do an update on the inflation rate. This top graph is the month-over-month rate, and it has been steadily lower than it had been in 2021, 2022, and such. So we see that with this is the month-over-month rate versus the overall year-over-year rate of the inflation, and it's coming down. So we hit 5%. Yay, I suppose. It isn't necessarily good news since it's still quite high, but seeing it dramatically fall month over month is nice to see, and hopefully that'll allow the Federal Reserve to not be overly aggressive, or at least continue to be very aggressive, the rate hikes. For those of you, since again I see a few new names that don't know much about the Federal Reserve and the rate hikes, when inflation is high, one of the ways to combat it is to raise interest rates. And when interest rates are raised, capital assets, so investment stocks, bonds, depreciate, and lending becomes tighter because interest rates are higher, so lending is more expensive. So less businesses will invest in growing, will invest in new locations, that kind of stuff. And mortgages will be more expensive for people, so people will buy less houses. So that is the rationale behind raising the rates to combat inflation and to hopefully stop in its tracks and avoid what's called hyperinflation, where it gets into a spiral, and that has destroyed economies in the past. So over the past year and a half, rates were risen quite aggressively, and now we're finally getting to the end of the rate hike cycle. This was the first meeting when there was really a true consensus of, is it going to be a pause? Is there going to be no rate hike? But ultimately, Jerome Powell, which is the Federal Reserve chairman, and the other members of the FOMC decided to still raise rates by 25 basis points. And if people ask me my opinion on it, I would say we probably should definitely consider stopping now. As we're seeing 4 bank failures now this year, and it's definitely getting some cracks into the financial system. But I understand the importance of raising and maintaining rates because inflation is still at 5%. It's quite high. So there are plenty of commentators out there that are more keyed into, like I don't have an economics PhD, but there are plenty of commentators that say this is the greatest things ever happened, the worst things ever happened, or somewhere in between. But bottom line, rates were risen today, which was when they announced it at 2:30, and hopefully in June we will see. I'm guessing likely a 0 basis point hike, so we'll probably stay flat, and I'm expecting they'll probably hold steady for the rest of the year approximately, and then maybe some cuts in 2024. But if there are cuts, likely that means something broke in the system. So we shall see, and I will keep you updated each month. So let's get into some performance. This, for those of you that are new, shows the average monthly return of the S&P 500 in historical averages. So in general, there's cyclicality to the stock market. November, December, January is the best 3-month period where usually you've probably heard of the Santa Claus rally that contributes to it at least. Usually you have some solid returns in those 3 months versus like August and September are tougher months. You usually, it is more common to see sell-offs in those months. So we just finished April, another one of those very good months, and it was pretty average. It was pretty flat, which we'll discuss in a bit. But what I like to show here is what to expect in the coming months. So May and June, considerably flat historically. So I would stick with it. That's what I would expect, that these next 2 months probably will be flat or negative, and we'll get into the charts and such, and I'll explain our rationale. So for those of you that are new, this is called a heat map for the stock market. This is how I see the stock market every day. Most people see it either on the tickers that run across Wall Street that are all in a line, or they see like the S&P 500 line chart. But ultimately, this is the best way to look at the markets. Is super information rich. It's broken up into the 11 sectors of the economy. The larger the square, the larger the company. So Apple's this largest square here at 2 trillion or whatever it is right now. And the greener it is, the better the returns. The redder it is, the worse the returns. If it's gray, then it's about flat. And you can see that these very large squares performed much better than some of the smaller, which means the large cap names outperform small caps. So you can see that also in the indices. So small caps over year to date, over this past 4 months, were down about 1% versus mega caps up 15%. And that's mostly due to Meta, which is up 100% year to date. They had quite a bad fall last year, where they were down significantly more than 50%. And it was basically an overreaction to overspending. And now they got that they've reined it in. Zuckerberg has calmed investors, and there's been quite a rally. So for those of you that bought at the bottom, congratulations, you made quite a bit of money. So quick run through of the indices. Dow Jones up about 3% for the year, S&P 500 8.5%, and mega caps 15%, which is about what you would expect. Dow Jones is usually more of a value-oriented indice, where it holds a lot of industrials and such that have lower multiples. And those were all the rage at the end of last year because people were afraid of the growth stocks, so they fled to value. And now there's been a reversal where essentially people fled from growth stocks too much, and people are now selling some of their industrials and repurchasing into some of their growth stocks like Meta or like Amazon or like Tesla. Small caps are mostly down because of the regional banks problems. Most of the small caps either fall into regional banks or biotech, and both of those haven't been doing that hot recently. So that's why the small cap indice is down. And the global ex-US, which means all the stock markets outside of the US, is up about 7%, so slightly worse than the S&P 500, slightly worse than the US stock market, but in line. And bonds up about 3.6%, so nothing crazy there, but a nice little gain. You see gold up 10%, which is notable since last year, every single month I was mentioning how gold had fallen, and it didn't make too much sense in an inflationary environment. And now we're seeing some gold catch up. Crude oil mostly flat. It's a very volatile sector, so down 4% isn't much. And Bitcoin, the biggest number on the chart here, up 77%. So those of you who have had Bitcoin since January 1st are probably quite happy. But then again, the year before that, probably quite sad. April, I won't go too much into this, but it was pretty much in line with what has been happening for the rest of the year. Small caps still down, mega caps outperforming the general S&P 500, the global ex-US in line with the S&P, and Bitcoin, gold, crude oil, mostly everything is flat. which you'll see in this next chart right here. This is the S&P 500 chart. This box right here, the end right here, is April performance, and it was remarkably flat in a month that had a lot of headlines. Last month, we had all the Silicon Valley Bank failures, which you see right here, quite a bit of sell-off. And then there was quick buying when the Federal Reserve and the FDIC said that they would cover deposits, and there was a whole lot of basically rhetoric to calm the market. So there was a quick rally. And I was pretty surprised. I thought we would give up some of those returns. We traded pretty flat until the end of the month when First Republic sold off. And then when we got the Chase purchase, it recovered quite nicely. So you don't see that often. If you look at the past months, even something such as May, where it's flat, it begins at around 41.50 and it ends around 41.50, you still have quite a bit of volatility. So what this tells someone that looks at the markets every day is there's some consolidation, and most likely there's going to be a move in one direction or the other. And unfortunately, I'm going to be pessimistic. I don't think we're going to break through this, what we call a ceiling in technical analysis, where this 4,200 ceiling, you go up and touch it, but you can't break through. Essentially, what that means is the people that are holding on to their assets, when it gets to a 4,200 level, they feel that is a valuable level enough to sell off their assets. There's downward pressure when you hit that. We broke through it in August, but quickly fell back down after that. So I wouldn't be surprised in the summer is we're going to continue trading between 3,800 and 4,200 for the S&P 500. So a lot of it's just going to be staying flat. It's probably going to be continuing to have some pain, probably revisiting the 3,900, 4,000 levels. But the nice thing for all of you that have 401ks or investments in the market, you'll continue to earn those dividends. And hopefully 2024, when we see rate cuts or we see us getting through a lot of this turmoil in the economy and the financial system, we'll see some nice recovery and possibly back up to these all-time highs. But I wouldn't. It's going to be a while before we reach the all-time highs, simply because there's been a revaluation with interest rates that are high. What is currently out there is simply worth less. So most people, for example, for those of you that have cash, you might have noticed that your savings accounts are paying 3 to 4 to 5% on your savings accounts. Why would you risk your money in the markets to get slightly higher returns when you could have a guaranteed insured bank account paying you that much? So simply because there's money on the sideline, there's less money in the stock market, which means we probably won't get back to those highs until rates are cut. So we will I'll keep you all notified when we hear some rumblings from the Fed in the coming months, if there's any kind of fears of cuts or anything like that. So that concludes this month's webinar. I did see at least one Q&A come in, but if any of you guys have any questions about what I talked about or clarifying anything you would like clarified, I would love to answer that for you. So one question that I had seen was about should you guys worry about the First Republic Bank failure? And I'm going to mostly reiterate what I had said about Silicon Valley Bank when I got a very similar question about that, is should I worry? And I would say bottom line, I don't think this is something to worry about, especially not about the money in your bank. Unless you're at one of the regional banks that is in the headlines that is teetering. If you have your money at the big four, Chase, Wells Fargo, Citi, or Bank of America, those are well capitalized, although they don't pay very much in their interest rates for savings accounts or anything like that. If you're at other large banks like PNC or Capital One, I wouldn't be too worried about any of this. And the nice thing is, it seems in this series of failures where there's shaky financials, the FDIC has come in and basically insured all deposits. Now, they haven't guaranteed that to be continuing in the future, but I think it's pretty fair to say that we will continue to see 100% coverage of deposits in banks for the near future. So I would not be worried about that, at least for your cash. What it means about the bank sector, and if you hold equities, if you're an investor in banks, or if you're an investor in the broader markets, I would not be surprised if this continued turmoil, especially if we see continued bank failures, which is possible, it'll probably have a negative impact on your portfolio. So it's something to note, but you don't need to worry too much about your day-to-day bank account. Let me read this one that came in. What does buying a bank do to ongoing dividends for Chase to stockholders? That's a great question. So before I talk about Chase stockholders, I guess I should mention the First Republic Bank stockholders. From my understanding, all of their corporate debt was wiped out, and all of their preferred stock was wiped out. So if I doubt you as an individual holds any First Republic Bank preferred shares, or any First Republic Bank corporate stock, because those would be almost entirely held by institutions. But those have been wiped out, and I believe all of the common shareholders will be bought out at a rate that is quite unimpressive in comparison to last year. But instead of having 100% loss, you'll probably be at a 95% loss. For Chase shareholders, Chase is one of the S&P 500's dividend aristocrats, if you ever heard of that term, which basically means they have always paid their dividends, and every single time that they pay their dividends, they raise their dividends. They would fall into, there are different ETFs out there, like the one that I'm thinking of is DGRO from BlackRock, DGRO, and that ETF purchases and holds companies that grow their dividends consistently and have never missed a dividend. And Chase is one of those. I believe it's in that fund. I'm not 100% sure, but I believe so. So I would not be particularly worried about them having their ability to pay their dividends. And on top of that, I'll say the deal that they came to for First Republic Bank was, if I can quote Mohammed El-Iran, who's a great economist, I think he said exactly, it is unambiguously good for Chase. Basically, they got this very profitable bank that services ultra high net worth clientele for pennies on the dollar. And sure, for the short term, they're locking up some of their working capital, but in the long term, their market share just continues to grow. So I would say if you're a JP Morgan or a JP Morgan Chase stockholder, I would not be worried about ongoing dividends, and you should probably be very happy about the deal. Like PNC, their stock dipped when it was announced that they didn't win the bid, and JP Morgan jumped like 3 or 4 or 5%. So the stock market sees it as a positive, and I would as well. All right. I think that is everyone's questions, just those 2 questions. Thank you all so much for attending this month's webinar. I hope to see you back next month, and hopefully I'll continue to bring you some good news, some better news, but we'll see. It's possible that since it's been trading flat, we'll see some down months, but as long as we stick through it, it'll be all right. All right. Good night, everyone.